Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow.
All right, I'm powered by Danny Moses being on the market call today. It is Wednesday, May 7th. Guy is parts unknown. You'll see him again someday. Don't worry about that. Danny Moses, he is the host of the On the Tape podcast. Great friend of everything Risk Reversal Media. Danny, how are you?
I'm good. I just realized as I'm looking at myself that I need a haircut, and there's no way that I could ever get my hair to look like yours. I just don't have that type. So anyway,
but you couldn't. But you have a beautiful head of hair. Don't worry about that.
Yeah, I'll get there. Yeah.
Hey, Danny, you're on Fast Money on Monday the 19th, which is going to be really cool. I think you guys are going to be seeing more of Danny probably on Fast Money once he kind of decamps back to the Northeast here a little bit from wherever you are. We don't even need to dox you one way or another. Lot going on today, Danny. The market, the stock market for that matter, is kind of stalled a little bit right below its 200-day moving average. We're going to look at some of the technicals there. We're obviously going to preview the Fed. We're going to take some stock of some of the earnings that we've seen. Disney today is really surprising to me, the guidance that they gave, and we'll break that down a little bit. First, a little housekeeping. Yesterday, we promoted Fast Money Live, which is going to be on June 5th. This is the second one that we've done. There's a few tickets left for this thing. Yesterday, when we promoted it, and we had a code just for our listeners, just for our viewers, a discount code. There it is, FM25. Really good discount on that. fastmoneylive.cnbc.com. A couple of you guys went and bought tickets, so we appreciate that. We're almost done there. It's a lot of fun. You come in at 4 o'clock to the NASDAQ market site where we do the show. You do a Q&A with our producer, Melissa Lee. Then you watch the show. Guy Adami is going to come into the audience, take a bunch of live questions. You're going to be on TV. And then the whole panel, we do a Q&A with you guys. And then we drink Como Tequila for like an hour. We have a cocktail thing, and we get to talk to everybody there. So go to fastmoneylive.cnbc.com. Use the promo code FASTMONEY FM25. FM25. All right, Danny, hopefully you'll be there. I mean, why wouldn't you be there?
I don't know, but those pictures that you have up, those are from 15 years ago. You guys all look great.
Pull it back up. Pull it up.
Let me see those pictures again, because
mine is literally probably a year or two ago, by the way.
Okay, but the others aren't.
Guys is like 2 years ago. These are all recent. Thanks a lot for noticing here, Danny.
No, there's no way that Tim's picture is 2 years old. I mean, he's handsome. He looks great, but that looks like 15 years. Anyway, as Guy would say, I digress.
I digress. All right, we have digressed here a little bit. Let's get to it. What are some of the things on your first, another piece of housekeeping. On the tape dropped this morning, you and Bethany McLean, amazing episode. I already listened to it. Bethany, just give the quick 411, because there were a couple things that you guys hit that I think are really pertinent to the environment right now. If you think the equity market is vulnerable, if you think the treasury market is vulnerable, if you think gold back towards new highs is telling you something, a VIX that's still elevated in the mid-20s, some of the things that you guys discussed today, specifically about private credit, I think were really important.
Bethany, if people don't know, was the writer of Smartest Guys in the Room about the Enron debacle, and she actually had cited it a couple years before. Obviously, she wrote that book. She was early. She's a well-known journalist and author. She's written about Fannie Mae and Freddie Mac, called Shaky Ground, about fracking in the U.S. So she runs the gamut. So she's been having this podcast called Capital Isn't with a University of Chicago professor. In the last 3 episodes, they've tackled 3 big issues. One has been the attack on legal system, both law firms and the judiciary. They talked about role of AI being for-profit or non-for-profit, right, among many other things. And then also about kind of Silicon Valley and their role in this accelerationism. But within all that, Dan, to your point, private equity plays a key role pretty much in everything. And we talk about that. And we talk about private equity, private credit, and why it's getting so big that if it does go south, it will inevitably need to be bailed out. And just because it's not, quote, in the banking system doesn't mean it can affect everybody. So she's really insightful. She made a comment on the podcast that she loves chaos. That was one of my taglines with you a couple years ago. She loves chaos.
You loved calamity.
Calamity. But she loves it so she can write about it. I like it so I could trade about it. And I'll say in the opening, I said, I think this is true. Hans Gruber in Die Hard was trying to take over Nakatomi Plaza, and he just kept uttering the words McLean because he ruined everything. Well, if you're a subject of an article or a book of hers, you would have the same reaction.
I
So
love
anyway,
it. I
Dan.
love Nakatomi Plaza.
Yeah.
All right, let's get to. I just before we get to the broader markets, I want to hit a big headline that just hit here. And I had Gene Munster, Deepwater Asset Management, that dropped in the Risk Reversal podcast feed this morning, and he and I were doing a review of some of the Meg 7 earnings. We spent a bunch of time on Meta and Google, and Gene and I have been having this conversation for a while, and we got to know this company Perplexity, I want to say a year and a half ago. The CEO, Arvind Srinivas, was on the pod February 2024. He was on Fast Money with us. This was my LLM, large language model of choice. It's an aggregator of the other ones, but they are advancing on the user interface like far quicker, in my opinion, than ChatGPT and Claude from Anthropic. And that's one of the reasons why I really enjoyed it. But here's the deal. I mean, I was never a fan of what was introduced for Apple Intelligence. It was a dead bang freaking loser right out of the gate. They introduced it last June at WWDC, and there was no there. And they said they were going to partner with OpenAI. And then afterwards, they quietly said, Gene and I talked about this, that they might be using Gemini from Alphabet. Okay, well, here's the deal. Eddie Q at Apple, they've totally pushed out all Apple Intelligence development right now. They just got it wrong. They rejiggered the entire group there. Here are the headlines coming out. I don't know where this is, but Eddie Q is now in charge of that. Searches in browser fell for the first time in April. What does that mean? Safari browser on the iOS. Google pays them $20 billion a year to have pole position, exclusive search. Okay. Apple exploring adding AI search to its browser, lost sleep. This is Eddie Q over possibility of losing revenue share, believes Perplexity and Anthropic could be options. So Google is down right now 5% on this. Why? That means that they are not considering Gemini right now. So Danny, I'm not going to ask you to opine on this specifically, but since this headline came out, I'm seeing tech stocks sell off. What does it mean to you that a headline like this by one of the largest market cap companies in the world, right, who has been left out of the left in the cold for this generative AI trade, that it can actually have this adverse effect on one of the ones that actually had accrued a bunch of value? How are you thinking about this? Because again, I keep coming back to, despite the quarters and the guidance, the CapEx guidance that a lot of these companies gave in the last week and a half or so, they're kind of stuck in the mud. I mean, like, they're not going anywhere other than Microsoft, for that matter.
Marvel, I guess, was another indication just in terms of sentiment. I know they're down in the food chain, but I guess I would say this two ways. One is that the beauty of the market caps of both Apple and Alphabet, Google, is that they can always buy their way into a business. And so whether they use their stock as currency or cash, they both have plenty of it. So I guess one philosophy would be you sit back and wait, let the Perplexities of the world or figure out who's going to win, and then maybe go in and overpay for something and slot that in as part of your strategy. I won't pretend to understand all the interconnected nature. Obviously, I can figure out the Explorer on Apple and so forth like that. Yeah. But I think it all goes back to one thing. And then the other overhang, Dan, as it relates to China and chip sales being there, I think there's this inherent, or there's an overhang right now that we've talked about this. We've moved from bears needing to prove their story from these levels to bulls needing to prove their story. And I think we've made that transition. And we all agree that the macro is fantastic for AI and the growth is real and the penetration is going to keep happening. But again, the similarities cannot be understated to 99 and 2000 with the building out of the internet. And there were so many winners that came out of that, but there was a lot of losers that ended up not making it through. And I think you're not going to see big failures in these big companies, obviously, but you will see companies get gobbled up that fit into the strategy. And so I think there's gonna be a lot of M&A, Dan, but the other part of that might be maybe the power that you need is not as big as people think to satisfy the consumer demand for what these consumer-facing tech companies are trying to provide, right? So that's the other part, CapEx versus function.
Yeah, because consumer thing seems to be a bit of a sideshow right now. I mean, people are not going to pay $20 a month for the most part, especially after that Google experience over the last 20 years, right? And so it really is about the enterprise and what the kind of uptake is on that front. And right now, Gene Munster said this. They had an AI summit. He had folks from Anthropic and Perplexity there that they hosted. And, the companies, I think he said Anthropic, he's like, right now, the two major use cases are coding and customer service. Well, that makes some sense, but that doesn't, my daughter, who's 21 years old, and she's a bit of a, I don't know what you call it. But she's a bit of a lefty, and I love it. I love everything about it. And you just remember when you were 21 years old and some of the views that you took or whatever. And so we'll sit around and I'll say, all right, let's Google that. Let's figure out what's going on. And I'll go to Perplexity. I'm still using Google as a verb. You know, she's like, no, don't search that on Perplexity. It uses so much energy just for that search, which I just find fascinating that is like a thought process in her head. But I guess bringing it back to the markets here is like that headline has taken Google down 5%. It's also taken, if Amanda wants to give us the like a 2 or 3 day chart of Apple, it's almost an acknowledgement of their failure in this strategy. And so, you know, that's Google right there, but Apple is selling off too. Look at that. Okay. So we've gone, to your point, from glass half full to glass half empty. And I think that's a really important narrative. Now let's go back to the 1 year chart in Apple. What's interesting, Amanda, if you could also put a 100-day moving average in there. So the 50, the 100, the 200, what I found interesting in this, Danny, there was a lot of talk about death crosses, right? Over the last month or so, it happened in the broad indices and it's happened in a lot of stocks. So the 50-day crossed below the 200. I want to say that was, start of April. So that was almost a month. It was a month ago. Now look what's going on. The 100-day is crossing below the 200. And it's about ready to do that. So a lot of bearish price action in Apple, and it just doesn't seem, despite what the company said about sales in China, you know, I mean, those were bad, but despite what they said about the tariff stuff, the pull forward, stock can't get out of its own way. I think, Danny, it's almost been down 10% in the last kind of, 5-6 trading days or so. So to me, I just think headlines, there's tape bombs out there.
Who needs AI when you have Amanda that can do it quicker than Perplexity?
Yeah, she killed
all these stocks, many of these stocks, and it's self-fulfilling how the S&P is going to trade versus how these big boys obviously trade here. So everything's in a range, and it's going to trade on sentiment up and down. Trade war, trade announcement, this, that, and the other. But listen, Apple's quarter wasn't good. They're the most consumer-facing, so they have that aspect of it, and they're the most China-facing to a degree in terms of manufacturing. So they have a little bit of both. And so I think that people feel like there's an opportunity cost at this point to be long Apple. You're not going to miss anything by not being there. There's other places to be. And so I think you're seeing a little market rotation today, I would imagine, overall out of tech and into other areas too.
Yeah.
So.
I mean, just again, the main takeaway here for Apple is that any headline that's going to cause them to kind of spend more money right now, I think, like, if they were to make an acquisition in the space, I don't know if it'd get approved. B, I just think that it's an acknowledgement of their failed strategy. And, Gene Munster said this yesterday, and he's like, unfortunately, I kind of missed like what the product, what could have been by now. And he's like, I was going out of the old Apple playbook. When they told you that they were launching a product, and usually they would give you a month or two, do you know what I mean? That sort of thing. They would deliver on that promise. And so they're not, I mean, this is probably one of the biggest whiffs that you can see in a long time. And the other thing I want to make the point about, Apple being well below its 200-day moving average, which is at 226. The stock's trading at 195 right now. Amanda did a screen on FactSet of companies that are above their 200-day moving average, 38% of the S&P 500, which is interesting to me. I want to pull up DoorDash because this is a company that reported yesterday, made some acquisitions. The stock was down a lot yesterday. It continues to be down today. And what's interesting to me about Dash here, if they could pull it up for a second, this is above its 200-day moving average, or it was that red line, the pink line, that's the 200-day moving average. So you're having a sell-off back from prior highs here a little bit, but there's still support. So I think it's interesting. And then pull up Uber, which doesn't look too different in a way. And obviously there's some comparison as far as their delivery businesses and the like. They're competitive. If you can pull that over a little bit. Yeah, you see what's going on there. Perfect double top. So Danny, from a technical perspective, just give the listener, the viewer, a sense of like how you use technicals. Is it an important input? Obviously, you usually start with very fundamental sort of issues on specific names. But when I'm just talking about all this stuff, and I know you go back with Carter Braxton Worth, with Vinny and Porter and that sort of thing, are technicals important to you, and why?
I think it's a great tool in behavioral finance because you can learn a lot. First of all, if you're late to the story, if you're early to a story, and it is important to know that the mantra of the retail investor and some institutional investors, for that matter, is I'm not going to sell until I get flat. which is a crazy idea because it's
Wait,
actually
just explain that. You get back to your price.
Yeah, you get your back to your money. So that's why you'll see charts. You see resistance. By definition, that works. It becomes self-fulfilling because you right when you get to that certain level where the stock has hung out the longest, that's where people are, quote, breaking even. So you see a lot of people are, oh, thank goodness I'm out of it, right? And so when it breaks through that, that means that something's changed in the story or a new group of investors has come in for some reason. So those are good things to pay attention to. Listen, I think charts are never to the starting point, but I think can be used as a great tool. And we've used them from time to time. And you know what? It also keeps you honest. Yeah. And there's sometimes the charts do line up with exactly big moments, either changes of management or changes in business strategies and things like that. And they are great things to kind of look at, I think.
Another way I think about it too, have a focus on the options market is like it helps inform strikes too. So you just mentioned, getting back to levels, you know what I mean? Well, oftentimes there might be support or resistance at those levels because they get really crowded, right? So if you're looking at this Uber chart, look at that breakout that it had, in October, and that had something to do with some competitive, situation with Tesla. They just had their robo-taxi event, huge breakout on huge volume. And look at where that gap was. Okay. A few weeks later, the gap lower was right where basically it broke out from, right? So there's some, you can take some information away from some of this. And the last point I want to make is let's pull up the S&P 500 as far as this 200-day moving average situation. And you just mentioned it, Danny. Look at where the SPX, where it stopped. Now it stopped right below its 200-day moving average. If you see that, which is kind of flattening out right now, look at the QQQ, the NASDAQ 100. It literally kissed its 200-day moving average and was rejected there. So that's just a situation of support, in this case, resistance, where, the technicals can kind of be informative there a little bit. So Danny, you look at this NASDAQ 100, the QQQ right here, looks like a double top. I mean, at what point they were through earnings season? Now we're getting some tape bombs that, like, literally this one today is adversely affecting two of the largest companies in the market. Would you trade off of these levels right here? And if you were, let's say, to short the QQQ or buy puts, would you put your stop at that 200-day moving average? Because a lot of folks, whether they're trading futures, whether they're trading the ETF, whether they're trading options, they're looking at the same thing, that prior high and that flattening 200-day moving average.
I wanted to add a couple other technical elements to look at, which is the relative strength index, the RSI on certain companies. I think option activity and open interest, certainly on S&P levels, is very important. That becomes a self-fulfilling buffer and or ceiling. It can be, depending on where those strikes lie. And lastly is the short interest. Yep. And, on certain names. So some of those are name specific. Some of those are S&P specific. As far as the S&P, I've been saying this for a while. I think we're going to stay range bound. I think you need to use opportunities on big swings up to clean up your portfolio, and on big swings down to take advantage of stocks that may be under pressure because they're part of a larger ETFs or part of the Qs or things that get kind of thrown out. So this is when you need to use passive to your advantage and be active. And that's the way I've always kind of looked at these things. And Dan, I'm much more prone right now to names like Verizon and AT&T with 4%, 5% dividend yields. Yes, they're not sexy. You bring up a couple of those names, those charts look good. And I'm, obviously the consumer is going to buy less phones potentially, but these are staples unlike they've ever been. No one's going to turn off their monthly service on their cell phone. It controls everything in their lives, right? It was kind of the auto payment back from the 80s. The last thing you don't pay is your car because you need your car. Well, you have Uber now also. So I think these stocks are very important. They're not sexy, but I think they're strong. So I hate to throw those in there, Dan, but these are tech companies that have morphed back into staple companies, I believe. So
yeah, no doubt. I mean, but they also have a shit ton of debt, and if rates aren't going lower and they have to roll the debt and all that sort of stuff, I mean, at some point, you tell me the sanctity of those dividend yields, they need to keep them. But there have been times in the past where they basically, cut those dividends and the like. So I'm with you on that. I want to go back to the S&P. I actually would take the opposite side, or let's look at the QQQ, for instance. I don't think we're range bound. I think that we had a V reversal, and I think we got back to levels where people are like, okay, well, we just got back to where the bottom fell out. We did not expect what happened.
Hold on, range bound, Dan. I'm talking about the range that's on that. So I'm telling you, we can go down to 400, 420. I consider that the range. Sorry, just so
it's a pretty big range at this point.
Well, that's what I've been talking about. So I apologize.
No, and I just think it incorporates a lot of news that is not being discounted anymore. You know what I mean? So yeah, we had a view reversal. The administration blinked on a big way. If nothing material comes out of these conversations with Bessent and these vice chairman, whoever this guy is in China, I think that then we become vulnerable once again to economic data and just some of the earnings stuff. And this is really important. When we were talking before about the AI trade. Let's put up Marvell, MRVL. This is a custom silicon company. They basically partner with the hyperscalers. It could be Amazon. It could be Google, and it could be Microsoft, and they're basically making custom chips to go into their servers in their data centers, which would be competitive with NVIDIA. What happened yesterday? This company they were supposed to have an analyst day. They pulled it, and they're pushing it out to do a Zoom at some point in June because of current market conditions. That's horrible. I mean, like that tells you that they don't report for a few weeks. They're going to shit the bed. What does it say about the whole competitive landscape as it relates to, GPUs and NVIDIA? And there has not been a good headline in NVIDIA from other than, some of the CapEx stuff. So Danny, you don't have to comment on Marvell, but pulling a analyst meeting because of the market conditions, that's not a good sign.
Not to be confused with the superhero
Yes.
complex, Marvell.
Yeah.
Listen, these are much more commoditized chips that we're talking about here. So they're not going to get the higher margin, right? And I'm not saying that NVIDIA will ever head to those margins, but it goes back to your point, Dan, is that it's unsustainable to think that NVIDIA can maintain low 70% margins. It just doesn't exist in hardware. And again, these are different type company, but just something to think about when things trade rationally versus not. This is trading rationally. You pull your guidance, you're going to get hit. And I know that.
No. It's not even the pull the guidance. I mean, they would basically say, we don't want analysts to come and sit with us and let us walk this through. And the one thing that is interesting to me is of all the AI chips that are being used, these are meant to be the most specialized. These are meant to be doing specific tasks. You know what I mean? So again, I just find that really interesting. The other thing is AMD, which was meant to be a player as it relates to competition to NVIDIA. If you go back, look at the 5-year chart really quickly. I mean, this stock traded, Guy and I talked about it yesterday, $225 in the spring. Look at that. And look where it's come. And look at the beat and the raise that they just put up, and the stock is unchanged on the day. So that's another thing that's telling you a little bit about this. In about 2.5 weeks, we get NVIDIA, so we'll be talking about that a lot more. Anything else, Danny, that sticking out to you right now that you want to focus? Energy was a name that, or a space that you wanted to discuss a little bit.
Yeah, the strategist at Bank of America, Savita, who we all know very well, upgraded the energy sector earlier this week based upon the fact that it's massively underweight. I don't know if we have those charts we can pull up, but not only is the short interest the highest on energy stocks, the long only community is the most underweight they've been in, I think, decades. And so when you saw an inventory last night that dropped more than people thought, WTI moved, let's call it $59-60 from the 56-57 level. These companies are in a whole different generation than they were during Trump 1.0. Between all the M&A, between their balance sheets, how much stronger they can withstand. And guess what? There will be no drill, baby, drill if oil hits $50. So I think these stocks, there's an argument to be made. The stocks haven't gone down, obviously, as much as oil. So you're getting a little bit of that in there. I just feel like these are great places to be. I looked at the quarters. They're hard to predict quarter to quarter, but ExxonMobil was pretty clean. There's that chart. I mean, look at these are the things from a behavioral finance perspective that you have to pay attention to. And don't go for confirmation bias on it. Think the other way on it. So I'm not saying you should sell industrials and buy energy, but something, just to kind of think about there. One is very economically sensitive. Well, both are, but both can perform very, very differently. So I just think, as she pointed out, Savita, in her note, the balance sheets are much better this time, and no one's going to tell them what to do with their balance sheet. So
let's pull up the XLE, the ETF that tracks the energy sector. The two largest components are Exxon and Chevron. They make up nearly 40% of the weight. So maybe this is not a fantastically constructed ETF, because you're going to be heavily weighted towards those. ConocoPhillips is at 7.5%. And then the Williams company. When I look at this, okay, you see that gap that was early April around Liberation Day, went through its 200-day moving average. And there, why did that sell off the way it did? Because I think the focus then was okay, what does this mean for global growth if we're going to have a trade war that might last a bit, and with some of the biggest economies squaring off with each other, and that's China and the US, I mean, it's going to like lead to weaker growth and less demand for energy. If you could pull this out to a 5-year chart, this thing's been stuck in the mud. I mean, it's like maybe if you want to trade ranges, you know what I mean, that sort of thing. So you get down to these current levels and you play for, holding support a little bit. Then maybe you get a rally in crude from 58.5 up to, 65, and these things get back towards, I don't know, like low to mid 90s or something like that. But, this thing's not getting away from you. And here it feels really heavy too. So, and crude is very heavy, so I don't know, is XLE worth looking at, or are you more focused on individual names?
I like ExxonMobil, XOM. You could bring that one up. But let me just say this. People that are listening right now and watching, if you're in the non-recession camp, I don't see how you don't own these stocks, because it's amazing, Dan, how many indicators there are in the market that are telling us we're going into recession or a massive slowdown, to your point. And if that happens, obviously, on an absolute basis, I'm not sure how these stocks do. On a relative basis, I actually think they'll outperform because they're much better. And that 5-year chart that you had up before, that was not stuck in the mud. I mean, that transformation in the industry happened from 2021. And if you put oil over the energy stocks since that time period, I'm not going to ask you to do that, you'll see the massive outperformance. And that's the re-rate, to my point about the balance sheets and all the M&A that has occurred. And so I'm just making the point that there's a reason they haven't traded down like oil has, and there's a reason that they're in a much better position they are. But again, if you're neutral on the economy at all, I think it's a sector you need exposure in.
Yeah. All right. Let's talk about this split screen. So yesterday, Guy and I talked about Paul Tudor Jones of, Tudor Investments, legendary macro investor. He probably spends less time looking at individual stocks and sectors and that sort of thing, but I'm sure the stock market is an important part of an investing mosaic that he uses. And that Tudor, they have plenty of folks that do look at sectors in the stock market and the like. And he was on Squawk Box yesterday morning on CNBC, and he was very clear. He does not think the lows in the S&P are in. Now, on the flip side today, you have legendary mutual fund manager, and this is Bill Miller. Where was he at? T. Rowe was at his jam. And Legg Mason, sorry. And was T. Rowe also in Baltimore or no?
Yes.
Yeah.
Yes.
And Legg Mason's in Baltimore too, right? Or
yes.
no? Right. Yeah. Which is kind of weird. You have Boston, you have Wellington, you have Fidelity, and then you have these guys down in Baltimore, which is not, I'd say a hot spot of investing. But so he's saying the lows are in. Who are you more inclined to get behind, the macro guy or the guy who managed long only money? And listen, he caught some massive waves in technology, in the 90s, internet and mobile social and in the 2000s. And I don't know what the hell he's doing. I know he's not at Legg Mason anymore. So who would you put your money behind right here, Dan?
Probably Paul Tudor Jones. Bill Miller certainly has seen a lot. Smart guy. Remember in The Big Short, he was the one in the room with Steve Eisman when Bear Stearns was imploding in real time, saying he was adding to his Bear Stearns position. So sometimes wanting something to be the case and it actually being are two different things. But to your point, everyone's going to talk their book. Paul Tudor Jones trades very differently than Bill Miller. Both are very smart. But I like the Druckenmillers and Paul Tudor Jones of the world because I think we're in a much more macro type of environment. And I think that they've all seen a lot. We've seen a lot over time. But again, I guess it's what your job is day to day. And if you're forced to be in the market and forced to own things, then you're going to pitch certain stocks. So I can see that.
All right, another guy that I love to put up there, and maybe he'll appreciate this a little bit, is my friend Doug Cass over there at Seabreeze. He writes for thestreetpro.com. He had a note out this morning talking about the Russell 2000, specifically through the lens of the IWM. And I think this is interesting because we've gone back and forth. Is like, what is the meaning of small cap stocks in this kind of macro environment, that sort of thing. And I think when you consider, and you guys actually get a great conversation again on the tape with Bethany about smaller companies, and they're going to be the first ones to feel the bite of a protracted trade war, but also higher interest rates, right? Slow down in the economy. And look at this thing. So look at that 200-day, and this thing broke its 200-day to the downside, like a month and change before the tariffs were put in place. So investors were already looking at this space saying, I don't know what's going to happen. I know that they keep talking about tariffs, but even if we have, some of the minimal sort of tariffs that we're discussing or were being discussed, 10%, on everything and this and whatever, the IWM, the Russell 2000 started taking it very seriously.
Stock picking occurs in the Russell 2000, not in the S&P 500, in my opinion. That's where you can make the most money. on the long side. And so when you see these type charts, you have to assume a lot of stocks are being included. Stocks that are covered by 0 analysts, 4 analysts, 7 analysts, right? Things like that. So when I see stuff like that, I obviously it doesn't look good. It looks very bearish, but I see opportunity. So within certain sectors, within the Russell 2000, right? Within, I think you really need to hone in on that and start to try to find something that, if this does continue, that is just getting indexed on the way down. You just got to be patient. But if this is, to me, is a stock pickers bottom up market that we're entering here, and this is perfect evidence of that, Dan.
All right, going back to, you just mentioned that, a lot of the data is signaling recession. We know that a lot of prominent strategists over the last couple of weeks, Torsten Slok, I think tops among them over at Apollo, he's suggesting that, and again, I'm just kind of paraphrasing a little bit, that if we were to have a protracted trade war, or there's just really no clarity over the next few months or so, that there's a very high probability, I think he used the term 90% probability, that we will have a recession at some point this year. And so some of this data is not, it's kind of out there. You got to look for it. It's not just the jobs number, the CPI or the PCE, that sort of thing. And this is something that, oh shit. Yeah, we got to do the Fed. Just pull up the chart of the day really quickly. This is from FactSet that I think was in the Daily Shot, which is, was from the Daily Shot. Retailers currently hold 35 days of inventory, which is near the record low seen during COVID. So this is fascinating, Danny. Really quick on this, because we had a bunch of retail CEOs go to the White House a little bit and try to kind of explain this. But in the not so distant future, we could have 20, 30% of the sort of stuff that is usually on the shelves at some of the biggest retailers not there.
Listen, this is being ignored for some reason. Maybe people think it's going to be transitory, and it's going to impact, as Bethany talked about yesterday too, not just small businesses, but the lower income consumers the most, right? And so things are going to be hard to get. People have been stocking up ahead on certain items. Again, feels like COVID again, but this one is self-inflicted. So this is a massive issue. And so the market is not really reflecting it, in my opinion. And I think it's just saying, oh, they'll figure it out. It'll just be a couple weeks delayed. Well, guess what? Those boats that bring over all this stuff, you know how much it's going to cost, because of the demand's going to be to send a container. If it was 10,000, it might be 30,000. So if you want to restock the shelves, Dan, it's going to come at much higher price, obviously, if it does happen. So this is real. So
yep, no doubt. We're going to keep tracking that. All right, last thing, let's look at the Fed today after the close. Like the CME Fed funds tracker is basically projecting, 0 probability of a rate cut. There's been lots of kind of back and forth. Obviously, the White House is really pushing hard on the Fed to cut interest rates. The conditions in which they will cut interest rates are probably the sorts of things that won't make you feel good about the economy. And then the markets too. I just don't think a rate cut helps the S&P 500 or any of the major indices right now. What are your expectations, Danny, heading in, and do you expect volatility afterwards? I think the most volatile day we had of a Fed day was back on December 18th, where it was kind of like a hawkish pause that went into place. The S&P got destroyed. I think it was down like 2% in a straight line, and it closed down that way.
It's interesting. This meeting, obviously, nothing's going to happen. The June meeting is now a 30% probability. That was as high as 60 a few weeks ago. So that's actually dropped, and I think we're 3 cuts for 2025 at this point. More importantly, Dan, he signaled this last call, which was that they're going to roll off mortgage-backed securities still, and then take the proceeds and reinvest them into treasuries. And so the Fed balance sheet is currently sitting around $6.7 trillion. I don't know how much lower they're going to go in terms of bank reserves and things like that. So I'm paying attention more to that, since we know that the 10-year yield is what Besant's focused on. It tends to be the be-all, end-all. They're participating, obviously, in some of these 10-year auctions that we've seen. So that's what I'm paying attention to. And remember, not that it matters, this is not a dot plot meeting. That's quarterly. That'll be the next one. And lastly, don't think for a second that, the market's been the barometer of what forces the hand of the White House. When the market's trading up, they seem to get a little more bold with their statements and not worry about doing trade deals. When the market trades off, they tend to go back in. Well, let's be clear. If the market trades off on anything that Powell says, you will hear rhetoric again from the White House: cut rates, what are you doing, this, that, and the other. So, I think we're going to be dealing with that type of volatility, Dan, going forward.
Yeah. And just again, I don't care much about a 25 VIX, but it's there, right? And the S&P is only down, less than 5% of the year. The NASDAQ is down about 9% on the year. I'm most focused on like a bit of a pastiche, as Amanda likes to say, of the VIX, the 10-year yield, which is kind of stuck here at 4.3%, gold, which is approaching those prior all-time highs, right? And you could maybe throw the dollar in there, the weakness there, and then the weakness in crude. And you put all that together, and to me, it really speaks to stagflation. It's something that, you've been talking about for a very long time on our podcast and the like over the last couple of years. And it really feels like it's here. I think before we actually have, investors, I don't know, tuned up about the high probability of a recession, I think that stagflation has to work into the lexicon. It has to be something that a lot of folks are saying, hey, what does that mean if you're on Main Street? You know what I'm saying? And like, yeah, you're feeling continued high prices, but the economy is slowing. So now you're starting to worry about, job security and the like, and you start pushing back on big expenditures, you know what I mean? Then you start seeing consumer credit pick up, then you see delinquencies. Like, this is kind of a really messy situation. And at this point, I don't think there's a really easy off-ramp from a trade perspective for the White House right now, Danny.
Yeah, I don't think we need 2 negative quarters of GDP to prove that we were in a recession, right? I think it's really how things feel. So whatever indicators you want to use, to your point, I think you said it best. When you start to worry about your job or you cut back on discretionary spending, those are the signs. I don't need anything to happen. So I do believe that we are in a protracted slowdown that is not being priced into the market specifically. I think S&P earnings in 2025 are too high. I think we're going to get more of an indication of that towards the end of this reporting season. I think over the course of the second quarter, we'll start to see that. And at some point, we'll settle into a level. Things are stagflationary. I'm not saying we're in stagflation, but they are. And so we'll see. Listen, again, I think there's still a lot of money. These flows continue to amaze me coming out of retail that we see into passive. They're still breaking records. And so I think there's a massive disconnect, Dan, to your point, between the stock market and the economy at this point. We'll see if the two meet in the middle somewhere.
Yeah, no doubt. All right. You guys know where to find Danny Moses on the Tape podcast. Go to the podcast stores, follow it there, rate it, review it, share it. That's how people find it. He's been doing an amazing bang up job there. Danny, I can't see your Pearl Jam basketball, the Seattle one. I do see it on your YouTube page. So also there it is, my man. There it is. I have the same. It's pretty dope. Go to YouTube and go to the On the Tape podcast with Danny Moses. Follow that there. They're putting all their podcasts on the YouTube also. And then lastly, just as a reminder, we don't have many tickets left. Fast Money Live. .cnbc.com FM25. And the other thing that we're going to do, other than you guys coming and having the whole event, it's going to be a lot of fun and meeting us and spending some time, chatting. We're going to send some really cool fast money. Risk reversal swag to you. So if you do sign up, use our promo code, send a screenshot of the registration to Amanda@riskreversal.com. We're going to send you a bunch of cool risk reversal media stuff, risk reversal pod, market call, the whole like. So Danny, appreciate you being here, man.
Thanks, buddy.
See you soon. Thanks.